we have a very contemporary, emerging hot topic for discussion. The next technical session is on the future of digital assets in India, crypto and beyond. Our moderator for the day is CA Sachin Kumar BP. I request CA Vinayak NL to escort CA Sachin Kumar BP onto the dais. Also request CA Varun Gore to escort Shri Mathew Chacko onto the dais. A huge round of applause for the moderator and the panelists.
Welcome, sirs. While we present to you with a book as our welcome token, I'd like to introduce our moderator, CA BP Sachin Kumar. He is the Chief Strategic Partner of Mrs. Manohar Chowdhury and Associates. He is currently an independent director in a Tech Mahindra subsidiary and a non-executive director in a London-based MNC. He has wide range of experience in advising leading Indian corporates and MNCs on various domestic and international matters and represented them at various appellate levels in India. He is currently the secretary of the Bangalore ITAD Bar Association. We welcome you, sir.
Let me now introduce to you CA Sandeep Jhunjhunwala. Sandeep currently leads the corporate and M&A tax practices in the firm Nangya Anderson India Private Limited in Bengaluru and the emerging laws practice of the firm nationally. Sandeep has spent more than 15 years working with Big Four accounting firms in their tax and regulatory practices. He specializes in the area of corporate international tax with expertise in strategic transaction advisory, cross-border tax structuring, and controversy management. With this introduction, we welcome you to the session, sir.
I now welcome our second panelist, Advocate Mathew Chacko. He is the founding partner of Spice Route Legal, one of India's fastest growing law firms and a leading technology law firm in the country. He heads the Technology, Media and Telecommunications Practice Group and is the only TMT lawyer in India to regularly assist clients in the intersection of various areas. He has worked in multiple jurisdictions, including at several international firms in Singapore. In fact, in 2021, he has been recognized as the leading individual by Legal 500, distinguished practitioner by Asia Law, and ranked by Chamber and Partners and featured as one of India's top 100 lawyers in private practice today. We welcome you, sir. I now hand over the session to our moderator, Sachin, sir. Over to you, sir.
Good evening, everyone. Office bearers of KCA. Ladies and gentlemen, in fact, while all of us were busy in meeting deadlines of income tax and GST over so many years, some of our children, you must know, that they were busy creating their digital identity in metaverse. And while we were busy in GST deadlines, income tax deadlines, for those who want to understand what metaverse is a virtual world. Metaverse is also a virtual marketplace. And you create your own identity there. In metaverse, you create your identity, what is called as avatar. And one avatar meets with other avatar for a chat over a coffee. And, they not only exchange thoughts, but then exchange goods as well. Which, in the current scenario, what we are discussing, the cryptos, virtual digital assets, cryptos and beyond, I think these transactions will have a huge impact. So we are here today with two eminent panelists with me, Mr. Jhunjhunwala and Mr. Chacko Philip, with me on to discuss this matter and to understand the impact of this virtual digital asset and its implications. So let's begin with this particular discussion. In fact, as we discussed, the metaverse, how it is creating ripples. In fact, you must know that there is something called NFTs and, cryptocurrencies. They also have created a kind of a buzz in the market. I was studying a particular magazine, and I'm given to understand that in global cryptocurrency market share is worth, I suppose, I'm given to understand that 5,200 million USD globally. And then NFT sale has hit 25 billion in 2021, and it is not showing the signs of slowing down at all. And in this particular scenario, the transactions of these cryptos and understanding this crypto is becoming quite important for us as chartered accountants. So this is an attempt for us to understand the change that is happening around us. The way transactions are being conducted, transactions are being concluded. Let us try to understand with two eminent panelists, Mr. Jhunjhunwala and Mr. Mathew. And let me first take the question to Mr. Mathew. Mathew, would you please let us know, what is this all about virtual digital assets? There is a lot of things that we hear about virtual digital assets, like people talk about blockchain technology, people talk about cryptocurrency, talk about NFT. Would you please throw light on what all these things to our audience? Thanks.
Thank you, and thank you for the introduction. So very quickly, when I started many years ago as a tech lawyer, one of the questions that my bosses, the partners I would interact with, would ask me is, Mathew, how can we trust that it is real, what we are seeing? How do we know that someone hasn't faked it? So for example, if you see a signed agreement, how can we trust that an agreement that is signed has actually been signed? And when it was signed, was it signed yesterday? Was it signed 2 weeks ago? Was it signed a month ago? So solution to that was something called digital ledger technology. A solution to that was something called timestamps. So if you look at Word documents from the 90s, some of them you will see 10:29 a.m., which means that document was prepared at 10:29 a.m. But then I figured out very easily that I could play with the code and make it 10:30 a.m. if I wanted to. Then how can I trust this? So some, and technically in this age controversial, former KGB officials came up with a way in which we can put in a code and it's a hash code. So for the sake of simplicity, let's just call it a software code, which makes it difficult to tamper with the time. Then they said, okay, so if you can not tamper with the time, then I can create a software database where all these time is recorded. That's what is called digital ledger technology. Another word, that was, let's say, blockchain beta. That evolved into a very similar technology, evolved into blockchain. And in 2008, this unknown person, whom crypto fans will call Satoshi Nakamoto, we don't even know if he exists. There is a joke in bars in Estonia that Satoshi Nakamoto is a Japanese-sounding Estonian former KGB cryptographer, right? And I've had the opportunity to hear this firsthand in a bar in Estonia. But he said that if we've got a central database and a way in which nobody can change what is in the database, if there is absolute trust in the system, then what is the difference between a software code that is verifiable in a central database and money that we get that is verifiable by a central bank. Satoshi therefore said this is cryptocurrency, right? 2008, blockchain worth 50 cents in 2010 to 50,000 in 2022, right? That was cryptography, that was cryptocurrency, because now you can use it to trade. And there is a central authority which says this is legitimate. Move forward, there are 20 other applications, NFTs, decentralized finance, which we will touch slightly. And Nirmala Sitharaman says, everything that is there on this blockchain that is tradable or worth anything, other than an RBI sanctioned central bank digital currency, is going to be called a virtual digital asset. And as I'm sure Sandeep will tell and Sachin will discuss, is now subject to tax. I hope quick, simple explanation of what a VDA is.
Thanks, Mathew. In fact, you touched upon an important aspect of the trust element. The trust element which, as a chartered accountants, one of the things that we enjoy is that once we sign a financial statement, unlike any other professional, if it is a doctor, he renders services, his accountability is to that patient. If it is an engineer and engineer constructs a building, the accountability ends for that engineer with rendering services and taking money. But as a chartered accountant, our accountability is not to one person. It is to the world at large. Because the minute we sign a financial statement, somebody sitting in some corner of USA decides to invest in a company here. So the element of trust is embedded in our signature. So when you say that trust is what that the VDA or blockchain technology gives, so it means that, the trust component which we enjoy is getting outsourced to a technology. So do you agree with it? And if you agree with it, the question next to you is, what about our profession, CA profession? So first to you, do you agree with the fact that the element of trust is being outsourced to a technology?
Oh, absolutely. So what blockchain does is create immutability. So a lot of, not just, to give you solidarity, not just for accountants, but also for lawyers, a lot of trust, a lot of filings will get automated and will be recorded by technology. Combine it with artificial intelligence, it's a scary new world.
Just over to you, and now he says that element of trust we enjoy, it gets also outsourced to kind of a technology. So what is that world we are looking at as a chartered accountants?
Thanks, Sachin. I think this gets us to the fundamental question that can technology take over humans? I do understand that blockchain in some sense is also called as a trust machine, and it's immutable. Once on blockchain is always on blockchain. There is a trail which is available. It's decentralized. Therefore, no government, no person in the world owns it. And there are all this audit trail related probably procedures that would get modified over a period of time. Now, I think we had this kind of doubts always, whenever there is a new law or whenever there's a new technology that has come in the past. Say, for example, when SAP came, the question was whether it will take away the work of bookkeepers, but we still have bookkeeping as one of the, jobs that we do in our profession. So just to answer it in crux, I would say that it may not take away that trust factor from the accountants, but the way in which we will perform our responsibility to the stakeholders in the outside world, that probably is going to change materially over a period of time in the blockchain environment.
So you mean to say that while the technology will not take away the element of trust from our chartered accountants, but maybe the way we conduct audit would undergo a change?
Definitely, yes.
So that would undergo a change, yeah, right. But interestingly, because of the immutability that was discussed, so if a transaction is immutable, so one of the outcome of this is something like this, which I envisage is, let's say today, when we look at GST reconciliations or 26AS reconciliation, so there is one number in my ledger, there is another number in another person's ledger. What number is there in my ledger is my version of truth, and what number is there in the other person's ledger is his version of truth. So there exists two versions of truth. So in a blockchain technology where the transactions are immutable, transaction happens quickly, and so therefore the trust element is embedded in that particular transaction. So to my mind, then there will not be two versions of truth. There will be a single version of truth. So which leads to a question: if there is a single version of truth, then there is nothing called my ledger and your ledger. It is one ledger. Because as Mathew was mentioning, it is a distributed ledger technology. That means if three of us are entering into a transaction, there is one ledger with you, one ledger with me, and one ledger with him. And all three ledgers show the same number. So that means the question of this reconciliations, 26AS reconciliation, GST reconciliation, will it be a thing of the past then?
Could be. I mean, though I'm not a technology expert, but what I understand is that in a blockchain, unless one block of that transaction is validated, it doesn't form a part of that ecosystem per se. That's the fundamental, right? But still then there will be a lot of transactions which are illegal. I mean, there will be perpetrators, right? We know that. There will be transactions which will be off the chain. So I'm sure that, this probably doesn't get answered so easily that with the blockchain system being there would not be any transactions which need not be validated. And this kind of reconciliations again may probably change its form, but it will not become a thing of the past.
Okay. Thanks for your views. And Mathew.
Sachin, before we move on, just to add in there, one of the things I keep getting asked when we talk about metaverse, Web3, blockchain, crypto is this something in the future? And there's some public news that I can share, a project that we worked on for 3 years. 16 of India's largest banks have come together to create a blockchain-based system that will hopefully eliminate documentation in letters of credit. Right? So the banks will talk to each other in the LC process through the chain, verify all of it through blockchain, record it, and eliminate papers. That is already happening in India as we speak. And it's all the big banks, it's none of the smaller banks. So if they can do it, then I'm guessing it's just a matter of time before the government realizes that forget all these private sector uses, the biggest use of the blockchain is probably in public sector.
Yeah.
And I'm sure Infosys will be at the forefront telling the government that this is what they need to do.
Thanks, Mathew, for that perspective. But I'd agree with you on that aspect. How pervasive it has become is. I would like to share one incident from my office. One gentleman used to come every 3 months for 15CA, 15CB certificate, and that means he had a remittance abroad. So therefore, he used to come for 15CA, 15CB certificates. And interestingly, 2 quarters he did not come. So out of curiosity, I thought he would have gone to somebody else, maybe because of the fees, or I don't know. So I just wanted to check with him, why is that either remittance is not happening or he has gone to out. Both were not the case. He said, no, I have not gone to anybody, and remittance is happening. I was quite surprised. How is remittance happening within 15 CACB? He says that he is using cryptocurrency to transfer funds. Now the question is, if things are happening like this for a transfer and a cryptocurrency, is it regulated by RBI, or can we suggest clients that, okay, Baba, instead of going through banking channels, can you go through this crypto route? Is it suggestible? What is that RBI's position on this? Because we are not very clear. RBI has come out with a guideline initially, a recommendation saying that you don't invest in cryptocurrencies. But then we also see that income tax has come out with provisions and says that 115 BBH, and it says that if you carry out an activity, I will tax you, 30% I'll tax you. So I'm not able to understand what is the position of the government. Would they like to do it, want us to do it, or they don't want us to do it? What is the position of the government and the RBI in this particular case?
Yeah, so again, short story. When I told my team that I am going to speak and discuss with both of you and the audience on this topic, I first went to my financial sector regulatory team. And they looked at me and said, Mathew, faltu topic. Right? That's the truth. But I have two colleagues in the audience who are part of the tech team. So I went to them and said, guys, can we do this? And they got super excited. Right? That's the situation in which the government is. The RBI hates cryptocurrency. They have said this formally. They got a slap from the Supreme Court. They are now saying this informally. They were threatened that they will still go back to the courts. But it is still very, very clear with anyone who deals with the RBI that they do not like cryptocurrency. And for good reason. Because like we discussed in the beginning, there is a threat that you will make the banks redundant. If you make the banks redundant, then the RBI will also be redundant, right? They will no longer have control over fiscal policy. Unfortunately, I don't think there is widespread acceptance within the government that this is a bad thing. Because one, it's giving a lot of people employment. Two, while the RBI doesn't like it, I don't think the RBI has yet understood what it is at the core that they don't like. So everything they've caught on, money laundering, terrorist financing, those are things that they've caught on. But the response of the tech guys are, okay, make a law on terrorist financing, make a law on money laundering, we'll obey it. But if you really study the potential impact of this, like you said, it will make remittance forms irrelevant. It will make, and when we go on and talk about DeFi, it will make bank lending irrelevant. It will make savings bank accounts irrelevant. The long-term impact of pervasive cryptocurrency will be like absolute trust in technology, and therefore no requirement for actors who bring trust into various systems. At the first stage, people like you and me, lawyers and accountants, notary publics, etc. At the next stage, banks. And at the third stage, if the banks are going, then central banks. But the question is, can we stop it? Are we rolling back technology? Can we roll back technology? What will the tech people say? Because after all, blockchain now employs millions of people in India. If we roll it back, millions of people have crores of money in blockchain. If we ban it, is it a violation of the constitutional right to property? Forget livelihood. Is there a problem? Suppose I have a house, forgive nationalization, but apart from that, if I have a house worth 50 crores, the government can't come and take it away. Banning cryptocurrency, if I have cryptocurrency worth 10 crores, can the government take it away? And if I have 10 crores, I'll get the best senior counsel in the Supreme Court to argue my case. It won't be that easy. That's why there is no uniform voice. All these debates are happening in the government in India. Before you start blaming the government, it's happening in the government in Singapore. It's happening with the government in the US. Some countries like Ecuador, fringe countries, Cayman Islands, Malta, Estonia have embraced this technology. But most larger economies are very careful. Good example is Singapore. If you asked me 5 years ago, I would have said the Monetary Authority of Singapore is extremely happy with cryptocurrency. But if you look at the tune that they are singing the last 3 months, they're saying, guys, treat this with caution. So there are problems, everybody agrees. The question is, how can we tackle the problems without killing the goose that is laying the golden egg, right?
Absolutely, absolutely. You said it so right. But I think one of the interesting things that I observe in this space is that for the first time, I suppose, there is a huge amount of trust of the people on a system where government is not involved. Wherever the trust of a people is implicit, if it is bank or any other institution, where government-backed things were there, so shares, securities or FDs are secure because it is backed by government. For the first time, very revolutionary, where government is not in it, but there is so much of a implicit trust of the people in the system.
The Sahara Parivar might disagree.
So, at the same time, we were also looking at, while government RBI stand, Mathew made it clear how India is taking a kind of a middle path. Government has come out with, Finance Ministry has come out with a provision from 1/4/2022 to tax this virtual digital assets. And they have said, looks to be very harsh. And they say that it is subject to tax at 30%. I will not allow you any expenses and all those things. And if I look at 115 BBH, it looks as a complete code in itself. It's a non-obstante clause, and it says that notwithstanding anything, that means forget everything, come to me. I'll tell you what to do. Is exactly how it says. Can you please throw more light, Mr. Jhunjhunwala, on the provisions of VDA and how it is to be taxed? And
Sure. So, Sachin, as you rightly said, 115 BBH is a complete code in itself. It's a special tax regime that the government has introduced, specifically saying that any transfer of VDA will attract a 30% tax. This 30% is the base rate. Surcharge and cess is over and above this. So, technically, a person who transacts in VDA will end up paying taxes which could range from 31% to almost 44%, depending on the slab rates and the surcharge and cess which is applicable. While it is a complete code and it's a special tax regime, there are a lot of open-ended questions. There are terms which are not defined. There are the manner of tax and the way in which one will get to know what is the consideration, what is the fair market value of the assets, what is the cost of acquisition. I think some of these things remain very, very open-ended as far as 115 BBH is concerned. There are two more sections which are related to, taxation of VDAs, which is one in terms of gift tax, which is 56(2)(10, very commonly known provision for income tax practitioners. And the second is a new withholding tax provision that they have introduced as 194S. So maybe we can take it up subsequently, but to complete that taxing regime for VDAs, these are the three particular sections that one will have to refer to: 115 BBH, 56(2)(10, and 194S.
yeah, right. Under that, they have defined VDA, what is virtual digital asset. And in the definition of virtual digital asset, which I'm seeing here, it says that there are about 6 pointers. If you fulfill all those 6 points, then it becomes a virtual digital asset. So it means it is an information or code or a token or a number, right? One, and it's not an Indian or foreign currency, and generated through cryptographic means or otherwise, and then it can be transferred, stored, traded electronically. And it says that it should provide a digital representation of value exchanged, and it is used in any financial transaction or investment. So these are some of the 6 pointers that they have given. And if all these things are ticked, yes, then it becomes a virtual digital asset. So my just question here is what Mathew was mentioning. Some of the countries have recognized it as a currency. So if it is recognized as a currency, then it is not a VDA under Indian Income Tax Act, because some other country is recognized as a currency. So if I transact with that particular country, it is not a VDA. So that transaction, which is not a VDA, to my mind, can I say that it is going out of the ambit of income tax because it is a capital receipt and so therefore not taxable? Can I take that contention?
Quite interesting, Sachin. I think this is a question that people had 2-3 months back, but just to give a little bit of guidance here, the only 3 exclusions from VDA are Indian currency, the central bank digital currency and a foreign currency. As you said, there could be countries which could have announced, say, for example, a Bitcoin as a sovereign currency, right? So therefore, you end up interpreting that Bitcoin then falls within the ambit of a foreign currency. Now, let's just look at what is the definition of a foreign currency. Foreign currency is a currency which is not an Indian currency. This is how it is defined under FEMA. But it says a foreign currency is a currency which is not an Indian currency. So therefore, what you need to test first is whether Bitcoin is a currency or not, right? That's a test that it needs to pass. And for that matter, not only Bitcoin, any other VDA. I mean, it could be, stable coin or any other cryptocurrency that we are talking about. Whether it is a currency or not is the first test before even we get into the point that it is a foreign currency or not. Now, that's where the way currency is defined under the foreign exchange regulations, it's an inclusive definition. So it says it will include banknotes, postal orders, checks, demand drafts, banking instruments, and any such instruments as may be notified by the Reserve Bank of India. Now, fortunately, unfortunately, this is not notified by the RBI, and therefore it will not pass the test of a currency itself. So I would rather take a position that VDAs will not get excluded, or any cryptocurrency will not get excluded from the definition of VDA just because it is not a currency as such.
Just to take an example of what I started when I said my son is in a metaverse and he has created a digital avatar of himself and he's transacting with, he wanted to buy a shirt, for your information, he wanted to buy a shirt digitally, I was quite surprised, and he's ready to pay for it, to buy it. Now the question that comes is, the amount that is transacted on a metaverse to buy a shirt for a digital avatar, so would it be considered as a virtual digital asset, and so therefore it is taxable? Just to take that example a little further.
Right. I mean, see, we have to understand that the taxing event, as per what the Indian regulators have provided under the provision, is transfer. So unless until there is a transfer happening, you just acquiring the asset may not trigger the taxable event in this case. But yes, in the example that you get, when that digital asset is subsequently transferred is when probably the taxation incidence will trigger, and not on the initial buyout. I'm talking from the person's perspective. It could be the case that the person who is the originator of that digital asset may still end up paying taxes under the provision, but the buyer in this case will pay taxes under the VDA tax provisions only in the case of subsequent transfer.
So if that is the case, I mean, thanks for that clarification, but then there are certain e-wallets point we have, and food coupons they get, and these food coupons are not given now, electronically it is given, you can redeem electronically, and these points what you get, e-wallet points, are something which can be redeemed. So these are the points, these assets, so to say, will it come under then virtual digital assets?
Oh, that's again quite interesting. I think air miles could possibly be another example, because people, pool in the air miles and then try and convert it into their actual flight tickets and all that. But in my view, I don't think they will. And if I'm not wrong, there was a news few months back where some of the ministries' officials had informally spoken to the press that, some sort of clarification or FAQ, whenever it is released in the future, will cover this point that some of these e-discount coupons or air miles for that matter will not get classified as a VDA for the sheer reason that first, it is not transferable. Second, it is not tradable. I think these are the two things that are very important in the limb of definition that you just read about VDA. I think you can argue that these are transferable because we have seen instances where, these coins and, points can be transferred to someone else, but these are not freely tradable. So I think that's possibly one of the reasons why a view could be taken that they may not possibly qualify as a VDA.
Yeah, Mathew, this interestingly, this when we talk about trading these virtual digital assets, which we just discussed, this could be a game changer because, when government, when it prints fiat currency, it is said that every 4 years they have to replenish it. There is a printing cost. there is a cost of transportation. So considering all those things, don't you think, government having its own digital currency will make sense? And I suppose the government is also considering something on this lines. Do you have any more information on this?
So it's very clear that the RBI is in the process of evolving rules for a central bank digital currency, right? What's called a CBDC, which is, let's call it Lakshmi coin, right, for sake of simplicity. But there is a problem with that, right, which I'm not very sure if the RBI has fully understood. Let's assume that there is an RBI blessed digital currency. One of the things that they will not be able to do is stop people from trading that currency. So they will not be able to stop me from giving Sandeep my Lakshmi coin. If I give Sandeep 1 Lakshmi coin, they will not be able to stop Sandeep 1 year later giving me 1.1 Lakshmi coin back. Right? It is absolutely secure. It is traceable, RBI blessed, blockchain is there. Now let's take a step back. If I have an exchange medium that is blessed by the government, which I can use to trade, which I can use to buy, which I can use to give to Sandeep and get interest. It's absolutely safe. Why do I need a bank? And if I don't need a bank, has the RBI really thought it through before launching the central bank digital currency? Because if I don't need SBI, and because this is centralized, I can do it on my phone, I don't need branches in my tier 4, tier 5 cities. If the RBI blesses this, in my view, not as a lawyer, but as someone who's been doing this for quite a while now, I think I did my first crypto deal in 2012. If the RBI launches a central bank digital currency that fulfills the potential of a central bank digital currency, it will be the end of our traditional banks. New banks may come up, which are digital only, avatar-led banks. But SBI will have to shut its shops. And is the RBI, are they willing to go there? If they are not willing to go there yet, they may be forced to go there in 50 years. But if they are not willing to go there yet, I would suggest caution on the central bank digital currency. And I think the moment they realize the ramifications, I think the RBI themselves will say, boss, this is one step too far. In fact, even the Chinese who announced CNY has rolled back what it means. The too much ego involved in rolling back the entire plan, but they've made so many restrictions on transfer that it's not worth it. But there is danger, I don't think, and for all my constructive criticism of the RBI, they generally, after making all kinds of noise, generally come and make the safe, sensible choice. At least that is my experience with them. I think after all this noise, and I think there's a lot of what my young nephew would call FOMO, fear of missing out, right? So with the RBI, I think there's a lot of FOMO. But I think eventually their new fintech department will figure this out. There's some really smart techies in that department. They'll figure it out, Reddit will figure it out, and finally they'll say this is nonsense, it has to stop. At least that is my hope. Or at least it has to be introduced over 25 years, 50 years, then okay. At least yours and my professional careers won't be affected.
But
I don't know about Sandeep.
But eventually, let us say, if it were to announce, as you rightly said, I agree with you that it may not happen this year or next year. Eventually, let us say it happens after 10 years or 25 years. So what would be the difference between the cryptocurrency that we are discussing and the digital currency announced by the government? What could be the major differences there?
If they were, I mean,
if RBI were to come back and say that, okay, I launched Lakshmi currency. Now there is a Lakshmi currency of RBI, and there is some cryptocurrencies, Bitcoin, many of those coins. So what would be the difference between those two then?
one would be authenticated, verified, liquidity guaranteed. I can give you one example of what the difference is. There is something called a stable coin. A stable coin is a cryptocurrency that is linked to a actual currency. So USD linked cryptocurrency, INR linked. In fact, there is an INR linked cryptocurrency. The idea is because it is linked to a currency, price is stable. That was the idea at least until 3 weeks ago, where absence of liquidity forced somebody to break the peg to the currency, right? So the value went down ridiculously. Now, when we discussed it in our office, some young 23-year-old said, but Mathew, George Soros did this to the pound and the dollar so many years ago. That's true. But I think the difference will be that the central bank digital currency, Lakshmi coin, will have large liquidity pool, veracity, but will offer the same uses that a cryptocurrency would use. So the lesser currencies would now stop being a currency and will start being a method for fundraising. So venture capitalists might, instead of buying shares, might buy cryptocurrencies. In fact, some of them are already doing it, right? Lenders might accept cryptocurrency as security.
Yeah.
But it will stop being so widespread.
Correct. One is yes, it will not be very widespread. Possibly it would be restricted to Indian borders. Vis-a-vis this cryptocurrency could be worldwide, and Lakshmi currency possibly could be Indian within Indian borders. Could be. I mean, we don't know, but that is one of the thought. And then possibly another one coming out of your discussions is that while the cryptocurrency, you don't have any of the restrictions, the fluctuations is so huge. Suppose this Lakshmi currency were to come, then possibly there will be a control of the RBI, so therefore they may not allow it to fluctuate as much as a cryptocurrency fluctuates. Could be what you think?
Absolutely. So because the pool of liquidity will be so deep, and because I guess at the end India's gold reserves back it up, right? I think yes, fluctuation will be zero. My reading of the RBI is that if the Indian economy grows the way it grows, in the next 10 to 20 years, the RBI might look at a freely convertible currency. If it's freely convertible, then it will go international. There will be no restrictions.
Yes. Yeah. Right.
But transaction costs will be close to zero.
Yeah, I agree. Yes. So, coming to the taxation aspect on this, Sandeep. See, to tax a particular transaction in income tax act, there are two parameters we look into. One is the residential status, and then the situs of the asset. So if the situs of the asset is here in India, irrespective of the residential status, it gets taxed in India. So in a situation like virtual digital asset, and government says that on transfer of virtual digital asset, there is a tax that you need to pay, where do you think could be a situs of the asset?
Okay, I think again, the limited law that we have today doesn't give too much of a guidance around the situs of a VDA, but let's just understand how the law is currently. So we spoke about 115 BBH as the section which defines the manner in which a particular transaction of VDA will be taxed, but let me tell you that the charging sections still remain the same, which is section 4, 5, 9 and 14 of the Income Tax Act, and therefore you need to go back and see if in the case of a resident, obviously the global income will be taxed. In the case of a non-resident, only the income which is arising from a source in India, or it is falling under those deeming fictions which are defined under section 9, whether it falls under that. And I think that's where situs of this particular asset becomes very, very important. Say for instance, in the case of shares or interest in a company, we have the deeming fiction that even if the transaction is happening outside India, but if the value of that share is deriving a substantial component of its valuation because of the assets in India, then you will deem that the situs of that share is in India and you will try and tax it. But in the case of a VDA, the most nearest corresponding asset that I could think of is an intangible, because it is not a tangible asset. And there is a very limited guidance which is currently available in terms of determining the situs of an intangible asset. We have cases where courts have said, in the cases of intellectual property, for example, that the situs of an intangible property will be considered as the situs of the owner of the intangible property itself. So if the owner of that IP is outside India, then you can probably consider that IP is also considered outside India. Now, in the case of VDA, unfortunately, we don't have too much of a guidance. Who is the owner itself is not known. Whether it is a person who mined that VDA is the owner, or is it the exchange on which it is getting transacted, is that the owner, or it is the platform or the node in which it is getting transacted, is that the owner. So I'm not too sure whether we can take guidance from whatever is available today in terms of situs of intangible asset, but the moment we get to know who is the owner of that VDA is when possibly we can decide that probably it should be taxed in India hands of the non-residents, or it should not be.
Mathew, just taking this example, what Sandeep was mentioning about, the situs, leave apart the income tax part of it. From a general law perspective, see, as you said, it is a distributed ledger. VDA will be there on the distributed ledger. Like, let's say cryptocurrency, it's on a distributed ledger. You are in USA, I am in India, and let's say he is in Singapore. And we three enter into a transaction, right? So from legal perspective, you have a ledger, I have a ledger, and he has a ledger. All three of us. That means that digital currency is on all our table. So from that perspective, how from general law perspective you determine a situs of an asset? Because even under general law, for that matter, as much as income tax, it is important. Under general laws also, we need to understand where the situs of the asset is. So considering this, what is your view on the situs of the asset?
So before we go there, the reason why Sachin said leave aside the tax aspect is the moment someone says tax, I'll go hide behind there. I don't understand it. But the chain itself physically resides in most countries. Does not reside in any one country. Therefore, technically speaking, the chain is outside India. Technically speaking, if you were to apply, for example, the FEMA, every crypto transaction has an international element. We are not applying the FEMA for lots of reasons. That said, like your tax jurisprudence, there is plenty of Supreme Court rules when you talk about the first phase of digital assets, right? Let's say sending architectural drawings through email from India to Italy, right? Or trademark infringement, someone starts a domain name called mcdonalds.in. Or someone sits and does something illegal in Russia, but targeting Indians, maybe in Hindi. There is enough rules which says, one, it's called the effects doctrine, which says if there is an effect in India, then Indian law will apply and situs will be assumed to be in India. The test case was someone started burning wood on the border of Canada and the United States. And the wood was actually burnt in Canada, but the entire pollution went to the US. The US court said burning might have happened in Canada, but situs of the pollution is the United States. So I think we'll have the same rules. I think we will come up with a system, not yet there, where we will say that if you can trade currency, the location where either the buyer or the seller is located, either or both will have jurisdiction. And once you have jurisdiction, the law of the place where that person sits, like situs, will apply. This is guesswork. This is not there internationally. but I can't think of any other sensible way to do this.
Yeah, we are currently we are doing a guesswork. In fact, we don't have an answer for any of these questions. But then the very fact that we are in a panel discussion today to elicit some of the interesting issues that may arise out of these transactions. And just for you, Sandeep, let's take an example of just taking a cue from Mathew, what he said, the transaction between parties. Let's take an example of import of a software, import of not even software, any goods for that matter. And the payment happens through a digital, virtual digital asset. Instead of rupee or dollar, it happens in virtual digital asset. Let us make it simpler still. The person who is selling has a permanent establishment in India. So therefore, obviously, the person having a permanent establishment in India, the income what he makes, income attributable to that transaction gets taxed is one aspect of the matter. Here, Indian person transfers the money through digital asset. So you mean to say this virtual digital asset transfer that happens because you have purchased goods will also subject to tax?
Yeah, I mean, in my view, it could be, let's look at the transaction. Let's split it into two ways. Let's first look at from the seller's perspective and secondly from the buyer's perspective. So, okay, let's start with the buyer's perspective here. From the buyer's perspective, definitely it's a case where he or she is transferring the crypto holding as a consideration, to the overseas party in the example that you gave. Transfer gets triggered, okay, taxable. From the other party's end, I think I should have just interjected when we were talking about this, when you asked this question, whether in some sense government has realized and made this a legal tender. Because if you look at the provisions of section 194S, it clearly says that if there is a consideration receivable in kind, right, that also needs to suffer a tax or a withholding per se. Now, just by stating that in the rule itself, in some sense indirectly says that I could do a barter or an exchange, or I could use that as a tender, as a legal tender to transact in goods or services. So in the example that you gave, from the buyer angle, definitely there is a trigger. 194S will get triggered because there's a transfer of the VDA holding that person has. From the perspective of the recipient also, you need to realize that it could be seen as a consideration which is flowing back from the overseas party to take that VDA. So therefore, under the law currently, it's not very clear that will it result in tax at both the parties' angle, or will it just get restricted at one party angle, which is the buyer in this case.
But looking at the way it is drafted on transfer of, they say notwithstanding anything, you have to come here the minute you have a digital asset, digital currency transaction, virtual digital asset transactions. So it looks like a person who has a permanent establishment here in India and which is settled through VDA, looks like there would be potentially a double taxation.
Yeah, right. In this PE example, may not be. Yeah, but if there was no PE, then could be.
Yes. So let's say, suppose if we take a example of, let's say, barter system of Ethereum to, let's say, Bitcoin. You have Ethereum, I have Bitcoin, and so for my 15 Bitcoins, I take 30 Ethereum. So how does this taxation work now?
I think, again, the fundamental principles will remain the same as compared to the previous example that we spoke about. It will again get taxed at both the levels, because in some sense, I am transferring my Bitcoin holding and you are transferring your Ethereum holding. So therefore, there is a transfer getting triggered at my end, there is a transfer getting triggered at your end. The question that remains open is how will you value it? Because, there is no clear valuation guidelines that they have come out with. But as far as taxability is concerned, I think it's quite clear that it will get taxed at both the parties' end, your as well as mine.
Yeah, true. In fact, this valuation mechanism brings me to another question to you, is that suppose in a first question that I asked about a non-resident is selling a product, and then it is being settled through virtual digital assets. So the question of 15 CA, 15 CB doesn't arise. I mean, because it is not happening through a banking channel.
Right.
I think that is one of the aspects, And second, considering that for regulation purposes, we need to have valuations. So I think that also is not very clear. You have any thoughts on that? Suppose if it were to happen, what is the scenario of 15 CA, 15 CB and the valuations?
Right. So 2-3 points here. One is, I think earlier we used to get these questions from our clients where they used to say that I've made payments through credit cards. So therefore, do I need to still, go and file a 15 CACB?
Correct.
And the answer that we used to give is yes, you have to, because end of the day, you have made a remittance and you have an obligation to report this transaction. Doesn't matter if you have not used your bank account, but have done the transaction through a credit card. Now, this question probably is not very simple if you are doing a transaction using a cryptocurrency. First of all, if it is a case of making a foreign payment, I'm sure that FEMA will not allow us to do that because it's not happening through a normal and authorized banking channel. But if we were to talk about, the applicability of 15 CACB per se, I would rather say I'm not too sure because the forms as it exists today definitely will not even allow me to report a remittance which has happened through something which is not a sovereign currency. That is point number one. As far as valuation is concerned, clearly no guidelines exist today. The nearest that I could think of is section rule 11 UA, where it talks about securities which are listed. So if I were to look at a Bitcoin example, I'll probably go and see where all Bitcoin is getting traded, which are the platforms. Say for instance, it could be on a WazirX or a Coinbase for that matter. On a particular day, at a particular time, what was the price at which it was listed, and the only flexibility that Rule 11 UA will provide me is that I can take the lowest of those values. This is again taking into consideration that I am trying to benchmark this transaction against a listed security, which may not be a current benchmark. But other than this, there is no other guidance which is available today as far as valuation of crypto or a VDA is concerned.
Yeah, thanks. In fact, another interesting connected question there for Sandeep is that this cryptocurrency is, let us say, virtual digital assets. Let's put it as virtual digital assets. You will not be allowed to claim any expenditure there, right? So let's take and also the question of whether it is a capital asset or stock in trade is of no consequence because both are taxed. If you hold
little consequence.
Yeah.
I'll touch up.
Hold. Okay. Please, so that you can explain that consequence. In fact, let me put it this way. Let us say I hold a virtual digital asset, hold it for more than 3 years, therefore long-term capital asset. I sell it, and I invest in a house property. You think I can claim 54F?
I think your question is very valid, Sachin. If we were talking before April 22, when there was nothing defined, now we have a special tax regime. So let's just take it up from the first question, where the classification of this asset, why is it important? Whether it is an investment asset that I am holding or is it a stock in trade? I think it's important only for the purpose of a 234C interest getting triggered, because if my income were to be taxed as capital gains, possibly I may not have
right.
projected my capital gains income, and therefore 234C interest may not get triggered. That's the only possibility. Otherwise, it's of no consequence. Whether it is a capital asset or a stock in trade, doesn't matter, because there's a special tax regime which is 115 BBH, which is going to tax my entire transaction. Now, coming to a question of 54F. 54F is about when you are transferring your long-term capital asset and you are investing in any house property. So let's understand, and assuming we are talking about the period prior to April 22, let's talk about someone who has done this last year, in the last fiscal year. There, the question is whether the crypto asset can get classified as a long-term capital asset. Now, the way a capital asset is defined is, it says capital asset includes any property. That's how that definition under clause 14 in section 2 starts with. Now, interestingly, under the current amendment in section 56 to 10, they have brought VDA under the definition of property. So you could say that it is a long-term capital asset because it is a property in some sense, and the law itself has blessed it by bringing that into the definition of what a property is for the purpose of 56(2)(10). So one can take a view that by earning capital gains income, long-term capital gains income, and investing in a house property, one could be liable to take that 54F benefit, but again, not free from doubt. But definitely, this is something which has a lot of legal merits in it.
So suppose, interestingly, if we were to take a position that 54F is available, and then if entire income of a person comes or arises out of only virtual digital assets and 54F is claimed, possibly then Chapter 6A deduction also could be claimed.
Yeah. But again, all this we're talking about the last fiscal year, not for AY 23-24 onwards, because we have a tax regime which is notified. Now, for the period prior to AY 23-24, definitely I think these are some of the positions that definitely could be explored.
We can, because the return filing happens now, so
Yes.
therefore, in fact, some of our clients, I must tell you that we got a notice. We were quite surprised how come this client gets a notice, because we had very diligently scrutinized his returns before filing it, and when we went to the investigation department, we came to know that this fellow has invested in cryptocurrency. So therefore, the question is, we have to now disclose those aspects, and when we disclose and where they have invested, we want to take certain positions. So for the before amendment, whatever these things have happened, and so therefore claiming 54F, or for that matter, Chapter 6A deduction is a position which one can think of taking comfortably, right?
Yeah.
Okay, so to have this Bitcoin, there is something called mining they do. Before I come to a question on allowability of that expenses, I would like to come to Mathew and just understand how does it Bitcoin gets generated, and what is this mining of Bitcoin? And if you can just because incidentally on that, I have a question to Sandeep, whether that expenses of mining is allowable as a deduction. So over to you, Mathew.
Right. So the easiest way to explain mining is to go back to your first comment, which is that at the heart of Bitcoin cryptocurrency is trust. And how does trust work? Trust works on the simple idea that if the crowd has verified something, has checked a ledger, has verified that it is correct, if so many members of the crowd unanimously have verified it, it must be correct. This process of verification is called mining. And as a reward for verification, you get a cryptocurrency. Is that?
Yeah.
There are technical nuances to that, but it is primarily what I understand from my nephew, and this I haven't done, is primarily solving a puzzle which will help you verify whether this ledger entry is accurate or not. And therefore, you're working to earn a currency. Your reward is that 1 Bitcoin, half a Bitcoin, whatever it is.
So just to earn that Bitcoin, that you have to solve that puzzle, which requires huge computing skills, huge power. So the expenses what we incur on this power and computers and high-end computers. So is these expenses be allowed as a deduction? Considering you may say that or expenses in relation to Bitcoins or virtual digital assets are not, you can't claim it. But then my question here is, it is not expenses. It is to create this Bitcoin, you need this. Otherwise, you don't have Bitcoins. Considering that, under Section 28 itself, would you be able to claim this? Because it's a profit is what we are offering to tax. Profit comes once it gets generated. Subsequent to that expenses, I agree, it is not allowable because of the specific law that we have. But then, to create Bitcoin itself, to create cryptocurrency itself, the expenses that what we incur. What is your view on that, Sandeep?
So again, as Mathew rightly pointed out, I think mining in a very common parlance is akin to manufacturing, right? Now, I mined a Bitcoin is something like saying that a product came into existence. That's when I got that Bitcoin. So therefore, in that sense, there are countries around the world, say for example, a US or a UK or Finland for that matter, where the taxing event is the mining of the Bitcoin itself. Now, as against this, there are another league of countries, say India, for example, or France, where they have decided or considered a disposal event as the taxing event, not the mining as the taxing event. Now, so therefore, in this case, just because the miner got a Bitcoin in itself will not mean that it will get taxed. It will get taxed only when there is a subsequent transfer of that Bitcoin, which is acquired by that person who mined it to any other person. At that point in time, the question that comes is, what are the cost of acquisition of that Bitcoin? Now, let's try and understand that it is cost of acquisition that I'm, restricted to offset against my full value of consideration. It is not cost of purchase, it's cost of acquisition, right? So therefore, technically, all this cost which is related to infrastructure, which is related to electricity, your network, internet, these are the costs that the miner possibly ended up spending to acquire that asset. The law is very clear that no offset of expenses other than the cost of acquisition will be allowed. So therefore, in some sense, one can again possibly take a view that all these expenses which are revenue in nature, which are not capital in nature, can be offset against the full value of consideration and can be offered to tax on a net basis. But interestingly, in one of the proceedings before the Lok Sabha, the Ministry of Finance has gone ahead and put answer to one of the questions where they have clearly said that any infrastructure cost will not be allowed to get offset. But to answer your question, infrastructure cost, clearly no. But some of the revenue expense like internet, electricity, because it's very huge, right? Those I still possibly think is a position that one could take that should be allowed to be offset against the value of the consideration that one gets to transfer those Bitcoins.
Okay, right. Thanks, Sandeep. And last income tax question on this, which I'll give you 3 scenarios for the sake of time, a paucity of time. 3 scenarios. Just would request you to comment on these things. Scenario number 1: there is a loss on sale of Bitcoin, and there is a profit on sale of shares. This is scenario number 1. The scenario number 2: sale of Bitcoin, loss, profit on sale of Ethereum. That is the second. And the third one, Bitcoin number 1, loss, Bitcoin number 2, profit. Please tell in all these situations how the set of losses happens.
It's fairly simple for me. It's not allowed in any of the 3 scenarios. A while back, we were taking a view that the second example that you gave, that profit on Bitcoin and loss on Ethereum, I could have still taken a view that, it's offsetable because it's all about one class of asset. Thankfully, again, this is coming very clear in that proceeding before the Lok Sabha, which happened in March, and it's available on public domain. They have clearly said that no set-off of losses will be allowed, even if it is within the same class of VDA or a different class of VDA. So profit on Bitcoin, loss against Ethereum, you can't offset. You will end up paying taxes on the profit. The loss is a sunk cost, it's a dead cost. You can't do anything about it. With shares, definitely not offsetable. With the Bitcoin 1 and Bitcoin 2 example that you gave, again, not offsetable because of the same principles that we spoke about for scenario number 2. So all gains are taxable, all losses are sunk cost.
Even in a third scenario where, let us say, Ethereum 1 profit, Ethereum 2 loss, even there we cannot do a set-off?
At a transaction level, if they are distinguishable, okay, it's not a fungible pool, there are 2 different transactions that we're talking about, then I would say that yes, you can't do that.
Okay, right. So, before we wind up, I think last question to both of you, and the various stakeholders in this crypto world, the investors, the government, the professionals, all of us, what is that we are looking from the government? Because the position is not clear yet, right? And what is that if we were to write to the government and say that, this is the clarity we need. So what is that clarity that both of you would like to seek from the government to make this workable, to make this, effective? Starting from you, Mathew.
Sandeep, do you want to go first? Give a tax answer.
Yeah, I can. So I think the only two things that are very clear from the current regulation is that one needs to pay tax in fiat currency. You cannot pay tax using virtual currency, right? That's the stand that government has made it very, very clear. You need to pay taxes in real currency. I think this approach somehow looks to me as, I don't know how many of us have traveled in a train or in a bus in our past life, but say for instance, people used to just keep a handkerchief on the seat saying that this seat is mine. So I think saying that government has made it clear that I will collect tax on this, and then the subsequent thing that used to happen is a fight between two passengers saying that no, I came first and you came first. I think that's something that government has to end up doing now, because there is absolute no clarity in terms of the taxing provisions. We don't know what a cost of acquisition is. We don't know how a valuation needs to be done. We don't know what kind of reporting will come into the picture, because the income tax returns obviously are very, very far from getting notified for assessment year 23-24. So I think the government, in whatever FAQ that it is intending to release in the future, I think there should be a very extensive stakeholder deliberation which the government should end up doing, just to understand what are the open-ended questions. I think people are ready to pay taxes because it's very clear that it's a very big ecosystem, and I think that's one of the reasons why government wants to tax this. And people may probably end up paying taxes, but they need a clarity in terms of when, how, and where they need to pay taxes, and a lot of questions around it. And therefore, I think one of the asks of the stakeholders in this kind of scenario is that they should make all these questions absolutely clear.
Thank you, Sandeep. And how about you? What?
Yeah, so I have a little bit more of a theoretical answer here. There was a filmmaker in the 1930s in the US, very famous film, made a movie, a digital movie, of course in those forms on videotape, of course, based on a book that was published by a famous author in the 1920s. It went up to the United States Supreme Court. And the judge of the United States Supreme Court said, and for those who play golf, you'll understand this reference, that I will give a judgment, but what I am trying to do is to plug a square hole with a round peg. So all of the government's actions till date, from the tax clarifications to the April 27th maintenance of record clarifications, to the FEMA clarifications that I understand will come in the next few months, they are all trying to apply a law that was not made for this medium to this medium. Unfortunately, if the government believes that this medium is the future, which I think slowly everybody is accepting that in the future this will become a big deal, then from the government, what I would request, and I think the association has a great role to play, is to go and say we need a standalone code. Firstly, is this legal? Is this not illegal? Can I hold it? This is international. Can I tax it in India? Can I do FEMA regulations apply? All of those. And flowing from that, standalone tax rules which apply for digital assets, treating not all digital assets the same way, but there are 10-15 different kinds of digital assets now. We need to treat all of them differently. Tax mining, why are we letting revenue of mining go away? Right? Tax trading, but maybe treat it as a capital asset, allow set off. Far more clarity is required. And maybe time for the Ministry of Finance to work closely with the Ministry of Information Technology. It's not a standalone, it can't be solved by one person. But yes, a more serious, involved attempt to solve this. Because if you look at the companies that are leading this technology, this revolution, Coinbase, Polygon, globally, India is where all the techies are from. We shouldn't let go of this revolution just because we're afraid of it. So a good comprehensive code would give us lawyers a lot more work.
So, I mean, questions have been really hypothetical one, but then thanks Mathew and thanks Sandeep for answering those questions so nicely and giving clarity to all of us. And thank you so much to both of you. And audience, thank you so much for your patient hearing. And if you have any questions, if you want to ask panelists any questions, it is open for 1 or 2 questions. Otherwise, we will call it. Yeah, please.
Sachin sir, check. Sachin sir, first of all, you have to forgive us. The topic is so interesting. We ended up having a parallel panel discussion over here. So coming to the question, since we spoke about the RBI's regulation around the proposed digital currency, just like how the physical currency is pegged against the gold reserves of a country, do you think the digital currency will have some kind of a pegging, physical or otherwise?
Would you like to take it? Yeah.
My take on this, it's guesswork of course, is that the digital currency will be pegged to the physical currency, which will be pegged to gold. So there is an indirect peg to the gold reserves that we have. I can't think of any other way to make this work.
I agree completely with what Mathew says, and that is the reason why there will not be a fluctuations if we do that. If we don't do that, then there will be a huge fluctuations, which will not augur well for the economy. And I think I agree. You have any thoughts on?
Yeah, I too agree, but the point is maybe they will create or determine a pool of that digital currency that they want to create, because in one of the examples that Mathew gave, that one stable coin, for example, they wanted to peg it against dollar, and they had so many subscribers that they needed $12 billion at one point in time, which was not possible for them. And then they started pegging it against Luna, which is another coin, right? And that's how their value started fluctuating. So I'm sure that the government will be mindful of this kind of events that has happened in the past, and therefore they will determine a pool and try and peg it against the actual physical INR, which in turn is related to gold.
Yes, ma'am.
In one point you said that crypto could be used for investments, venture capitalists to invest, right? So I just wanted to check on the taxation part of that. Now when we invest it as a venture capitalist, there would be returns on that. So the returns would be taxed on accrual basis, or it would be only when we sell those assets or VDAs?
So I think to answer your question, I would need to know whether the interest is flowing back to the VCs in the form of VDAs itself, or is it a real...
In the form of VDAs.
Then I think again it will get taxed, because there's a...
Yeah, it will get taxed, but I want to understand the point of taxation. Would it be on accrual basis when I'm getting the returns?
Should be, because that's when your transfer will happen, right? Because everything is...
I am not
to
materializing
transfer.
it into cash. It would still be in VDAs.
Yeah, but then I couldn't think of transfer getting triggered at the time of accrual. If you contractually agree that, okay, I'll keep accruing this in the books, but still the person, the VC in this case is a
If
legal...
I can give a parlance, now we have some FDs maintained and the interest is accrued and the interest is credited to our account when we are maturing the FD. So on accrual basis, as on 31st, whatever is the interest is credited, on that it is being taxed, but I'm not getting the money. So here also, VDAs are getting credited monthly or quarterly or whatever. So when the VDAs are credited to our account, that is the point of taxation, or when I am actually selling those VDAs and converting it into fiat currency, that is when it gets taxed.
I would think when it is getting credited to your ledger is itself when it will get taxed.
Thank you, sirs, for talking about how cryptocurrency can ease certain transactions and at the same time sometimes pose a threat to the economic system. Also, thank you for enlightening us on tax provisions relating to virtual digital assets. I now request CA Naveen Hegde to present a memento to CA Sachin Kumar BP, our moderator. Thank you, sir, for moderating the session so wonderfully. A huge round of applause, ladies and gentlemen. I request CA Siddharth Javli to present a memento to CA Sandeep Jhunjhunwala as a token of our gratitude and appreciation. Thank you, sir, for throwing light on tax provisions relating to VDA. I request CA Nagaraj Shivalinga to present a memento to Shri Mathew, Chacko as a token of our gratitude. Thank you, sir, for wonderfully explaining some of the practical aspects of VDA and cryptocurrency.
Ladies and gentlemen, a huge round of applause for our moderator and our panelists. Let me tell the panelist and the moderator that those are the live caricature that is presented to you, and those are not NFTs or cryptos, so no issues from tax or regulatory perspective. Thank you so much, sirs, for this wonderful session. Thank you.